2025 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. And if you would like to withdraw your question, press star 1 again. Thank you. And I would now like to turn the conference over to Melanie Straight, Head of Investor Relations. Melanie, you may begin.
Thank you and good morning. Thank you all for joining us today to review DigitalOcean's second quarter 2025 financial results. Joining me on the call today are Paddy Srinivasan, our Chief Executive Officer, and Matt Steinfort, our Chief Financial Officer. Before we begin, let me remind you that certain statements made on the call today may be considered forward-looking statements, which reflect management's best judgment based on currently available information. Our actual results may differ materially from those projected in these forward-looking statements, including our financial outlook. I direct your attention to the risk factors contained in our filings with the SEC, as well as those referenced in today's press release that is posted on our website. DigitalOcean expressly disclaims any obligation or undertaking to release publicly any updates or revisions to any forward-looking statements made today. Additionally, non-GAAP financial measures will be discussed on this conference call, and reconciliations to the most directly comparable GAAP financial measures can be found in today's earnings press release, as well as in our investor presentation that outlines the financial discussion on today's call. A webcast of today's call is also available in the IR section of our website. And with that, I will turn the call over to Paddy.
Thank you, Melanie. Good morning, everyone, and thank you for joining us today as we review our second quarter 2025 results. We continue to make meaningful progress on the strategy we laid out at our Investor Day back in April. This is evidenced by our strong second quarter results and supported by the fact that we are raising our full-year guidance on both revenue and profitability metrics. My comments today will include a recap of our Q2 financial results and an update on both our progress in product innovation and our enhanced go-to-market strategy across both core cloud and AI, which are enabling over 174,000 digital native enterprise customers to scale on our platform. Let me start with the second quarter financial results highlighted on slide 10 of our earnings deck. The growth momentum from Q1 continued into the second quarter with revenue of $219 million, growing 14% year over year. We saw excellent strength in our AI/ML business, with revenue growing north of 100% year over year. Revenue from our Scalar Plus customers, or customers who were at $100,000 plus annual run rate during the quarter, continued to see strong growth during the quarter at 35% year over year, and increased to 24% of total revenue. Finally, we achieved incremental ARR in the second quarter of $32 million, our highest incremental ARR since Q4 of 2022, and the highest organic incremental ARR in over 3 years. Given our strong top-line performance in the first half of the year and our confidence in the second half outlook, we are raising our full-year revenue guidance range to $888 million to $892 million. We are also excited about the traction we are getting with larger customers and increase in committed contracts. I spoke last quarter about a multi-year $20 million plus committed deal, and this was a contributor to the material growth in our remaining performance obligation balance as we continue to seek and secure large multi-year deals with our higher spend customers and key strategic partners. Not only did our momentum carry over to the second quarter, but also the growth continued to come with healthy profitability, including adjusted free cash flow of $57 million, which is 26% of revenue. As a result of this performance, we are raising our full-year free cash flow guide to 17 to 19% of revenue, demonstrating our ability to accelerate revenue while maintaining attractive free cash flow margins. Turning to the balance sheet, we continue to make progress on our capital allocation priorities and remain on track to address the outstanding 2026 convertible debt prior to the end of this calendar year. Matt will go into further details on this front in his prepared remarks. Now, let me give you some updates on the product innovation that we continue to deliver for our digital native enterprise customers, which you can see highlighted on slides 11 and 12 in the earnings presentation. During the quarter, we released more than 60 new products and features addressing the needs of our higher spend customers, which includes builders, scalers, and Scalar Plus customers who now drive 89% of our revenue. Notably, 64 of our top 100 customers have adopted a product or a feature released within the last year, and 26 of the top 100 customers have adopted a new capability released within the last quarter. Both clear proof points of the impact product innovation is having on our digital native enterprise customers. Let me now provide a few product highlights from the quarter, starting with Core Cloud. This past quarter, we officially announced our Atlanta data center, and its resources are now available to all customers. As a reminder, this is our newest and largest data center, and it is purpose-built to deliver high-density GPU infrastructure optimized for AI inferencing, which requires a lot more than just GPUs. This data center has our core cloud stack, including compute, storage, and other cloud features that are critical to enabling AI-native customers to run full-stack applications powered by AI, and not just the training or inference part of their software. This agentic cloud data center infrastructure is a key differentiating factor for us over other neoclouds, as it provides a complete stack for running sophisticated AI applications that have comprehensive needs beyond GPUs. More on that a little later. During the quarter, we continued to build capabilities for larger digital native enterprises. These customers typically require high-quality storage, especially for AI workloads. To support that requirement, we enabled NFS, or network file systems, for GPUs so that customers can run the most demanding GPU applications with access to higher performance object storage to meet the demands of enterprise workloads such as video streaming and data lakes. We also introduced 2 advanced networking features in public preview: Bring Your Own IP Address, or BYO IP, and Network Address Translation Gateways, or NAT gateways. These are critical capabilities that will enable more and larger digital native enterprise workloads to migrate to DigitalOcean. BYO IP allows customers to use their existing publicly routable IP addresses on DO rather than having to acquire new DigitalOcean-specific IP addresses. This makes it easy for customers to lift and shift their workloads to our platform without requiring extensive changes to their applications, while NAT Gateway allows the customer's resources to securely access the internet from within their virtual private cloud on the DO platform. These innovations on the core cloud platform are enabling us to scale and win more workloads from our digital native enterprise customer base. To leverage that traction, we are complementing our industry-leading product-led growth motion with a small dedicated migrations team to support customers moving existing workloads from hyperscalers and other clouds to DigitalOcean's platform, and we facilitated 76 of these migrations during the quarter. One example of this is a company called Exitium, a next-generation cybersecurity provider delivering innovative, no-cost incident response as part of its fully managed Security Operations Center, or SOC, offering. Designed for businesses and managed service providers, or MSPs, Exitium's managed SOC provides real-time threat detection, threat hunting, and incident response, all without the high costs typically associated with legacy solutions. Exitium signed an 18-month contract with DigitalOcean, selecting the platform to migrate from other cloud providers due to our compelling total cost of ownership, performance, and ease of use, enabling Exitium to deliver its cutting-edge cybersecurity solutions more efficiently and at scale. Servd.host, a Scalar Plus customer that offers managed hosting specifically tailored for the Craft content management system, has already adopted our newly released Network Address Translation Gateway, enabling their customers to securely access the internet within their DigitalOcean virtual private cloud. We're also very excited about the progress we're making on our AI/ML platform, which we now call the DigitalOcean Gradient AI Agentic Cloud, which complements our full stack general purpose cloud. Slide 8 in the earnings presentation shows the power of having these two platforms side by side, enabling our customers to take full advantage of the integrated stack that is required to build and run AI-powered applications in the future. The Gradient AI Agentic Cloud has three components: Gradient AI Infrastructure, Gradient AI Platform, and Gradient AI Agents. Let me start with the Gradient AI Infrastructure, where we expanded our GPU droplets lineup significantly to now include 8 major types, including the H, L, and RTX series GPUs from NVIDIA, and the latest Instinct series GPUs from AMD. Another major update that makes Gradient AI Infrastructure great for inferencing is a new inference-optimized GPU droplet, which simplifies the setup and deployment of LLMs by leveraging Docker. And this new GPU droplet comes pre-configured with vLLM and includes built-in optimizations like multi-GPU parallelism, smart batching, faster and higher token generation, built-in support for Hugging Face model downloads, speculative decoding, prompt caching, and multi-model concurrency, so that customers can go from deployment to serving tokens in minutes on any GPU droplet without having to do all these steps manually. We recently announced a collaboration with AMD that provides DO customers with access to AMD Instinct MI325X GPU droplets in addition to MI300X droplets. These GPUs deliver high-level performance at lower TCO and are ideal for large-scale AI inferencing workloads. Another example of this growing collaboration between the two companies is the Gradient AI Infrastructure powering the recently announced AMD Developer Cloud, which enables developers and open source contributors to test drive AMD Instinct GPUs instantly in a fully managed environment managed by our Gradient AI Infrastructure. This enables developers to start AI development with zero hardware investment and accelerate the time to value in tasks like benchmarking and inference scaling. This further advances our mission of democratizing access to AI while maintaining the quality, performance, and flexibility our customers have come to expect from DO. Let's look at how customers are taking advantage of our Gradient AI Infrastructure. Featherless.ai is a serverless AI inference platform offering API access to an expansive and growing catalog of open-weight models, primarily Hugging Face models like Llama, Mistral, Qwen, DeepSeek, RWKV, and more. Featherless AI leverages DigitalOcean for its simplicity and price performance, and they were an early adopter of our AMD MI300X GPU droplets, which offer industry-leading price performance and ease of use for inference workloads. Another GPU droplet customer is Scribe AI, a digital native enterprise specializing in AI-generated documentation, which is used by 94% of the Fortune 500 companies. Scribe AI migrated their AI/ML training workloads to DigitalOcean from competitive cloud providers and is now leveraging DO's GPU droplets to build and train their process documentation and knowledge sharing platform. Moving on to the next layer of our Gradient AI Agentic Cloud, we recently announced the general availability of DigitalOcean Gradient AI Platform, which provides the industry's easiest and most cost-effective platform for developing production-grade AI agents with automated safety and security guardrails. The Gradient AI Platform, as shown on the right side of slide 8 of the earnings deck, is a one-of-a-kind platform that caters to the end-to-end agent development lifecycle, or ADLC for short, enabling AI-native, SaaS, and any software application customer to build, test, deploy, monitor, and operate agentic AI software. Customers can use a rich set of proprietary and open source foundation models, including OpenAI, Anthropic, Mistral, DeepSeek, and Llama as high-performance serverless endpoints. These serverless endpoints automatically scale to meet real-time application demands, thus freeing customers from having to manage compute resources on their own. The Gradient AI platform provides built-in guardrails that verify AI behavior and new best-in-class agent evaluation framework to drive high accuracy and relevance of AI results, and a robust experimentation capability to deliver optimal AI performance. Over 14,000 agents have been created since announcing this platform, which is almost double the number of agents last quarter. More than 6,000 customers have leveraged this platform since January, with 30% of these customers being new to DigitalOcean. One of the customers leveraging our new Gradient AI platform is Quickest with a Q, a leading AI-powered collaborative workspace product that helps product, marketing, and sales teams generate strategy documents, campaigns, and playbooks using shared AI personas. Quickest leverages the Gradient AI platform to create persona-generating agents, enabling model comparisons and orchestrating tasks on the Gradient AI platform to fetch and summarize the markdown content. Quickest chose DigitalOcean because they needed a flexible and scalable infrastructure to support complex AI workflows, and they valued the simplicity of deploying agents and integrating them to the Quickest product line with very little coding involved. Moving on to the Gradient AI agents layer, our first commercial AI agent is the cloud-based Copilot, which continuously monitors critical server components like the web stack, disk space, inodes, and host health to detect issues in real time, diagnose root causes, and deliver actionable recommendations faster than traditional alerting systems. An example of a customer leveraging this product is Mint Media, a full-service media and marketing company specializing in video production and digital marketing. Mint Media uses our cloud-based Copilot Gen AI agents to automatically detect and remediate web hosting issues. Mint Media manages over 180 websites and saw significant time savings by leveraging cloud-based Copilot and the associated AI-powered insights and automated issue resolution. What previously required hours of manual debugging is now handled in minutes through the agent's detailed, actionable recommendations. In addition to the product innovations we delivered, we also made material progress on the go-to-market front during this quarter. From a new customer acquisition perspective, we saw meaningful progress at the top of the funnel from our product-led growth enhancements, with revenue from core cloud customers in their first 12 months significantly outpacing growth of prior years, which is a great leading indicator of future growth potential. Our direct sales motion and the strong ecosystem partnerships are driving more AI-native customers with large-scale inferencing requirements than we have ever seen in the past. Our growing success with these marquee customers is evident in the increased RPO that I mentioned earlier in my comments, and we anticipate this trend to continue as we scale out our AI capabilities. In closing, I am pleased both by the results of the second quarter and by the progress we are making on the strategy that we articulated at our Investor Day back in April. We maintained our top-line growth momentum from Q1 to Q2 while maintaining healthy profitability metrics, enabling us to raise our guidance across both revenue and profitability metrics for the fiscal year 2025. We delivered continued product innovation and both drove improved performance in our industry-leading product-led growth engine and continue to get traction with our direct sales go-to-market motion, especially for AI. We recently launched the Gradient AI platform into full general availability, a significant step in our offering to our customers, a twin stack of cloud capabilities as outlined in slide 8 of the earnings slide deck. In a single unified stack, we provide a mature, complete general-purpose cloud, and on the other stack, a modern agentic AI cloud. These integrated stacks enable AI-native customers to run inferencing at scale while taking advantage of the core cloud modules, and digital native customers to build AI directly into their software applications without having to do the heavy lifting of dealing with AI infrastructure. With this unique twin cloud and AI stacks, we are getting increasing momentum with AI-native companies with larger scale inferencing workloads, and we are expanding our partnerships with key ecosystem players in the AI domain. We're also making good progress on our balance sheet and refinancing priorities, positioning us for a strong 2026. Thank you, and I'll now turn it over to Matt.
Thanks, Paddy. Good morning, everyone, and thanks for joining us today. As Paddy discussed, we are very pleased with our Q2 2025 performance, and we are confident in our ability to sustain and build on this momentum in the latter half of the year. In my comments, I'll walk through our Q2 results in detail, provide an update on our balance sheet and capital allocation strategy, and share our third quarter and full year 2025 financial outlook. Starting with the top line, revenue in the first quarter was $219 million, up 14% year over year. Our annual run rate revenue, or ARR, was $875 million, which was $32 million above Q1. This incremental ARR of $32 million was the highest incremental ARR since Q4 of 2022, and the highest organic incremental ARR achieved in over 3 years. We continue to build and strengthen our relationships with our higher spend customers and key strategic partners. This is evidenced by the material increase in our remaining performance obligation balance as we continue to secure large multi-year deals with our digital native enterprise customers, which is an early but promising new go-to-market motion for the company. Our product innovation and go-to-market enhancements are resonating with this target customer base. In Q2, revenue from our Scalers Plus customers, or customers whose annualized run rate revenue in the quarter was greater than $100,000 and who represent 24% of overall revenue, grew 35% year over year, with a 23% increase in customer count. This is clear evidence of the increasing traction that we are getting with our largest customers as they expand their use of our core cloud products and adopt our new AI offering. Q2 revenue growth was primarily driven by improvements in customer acquisition across both core cloud and AI, as well as strong customer adoption of our AI/ML products. As Paddy mentioned, revenue from core cloud customers in their first 12 months significantly outpaced growth of prior years, which is a great leading indicator of future growth, as these stronger recent cohorts not only drive up revenue from customer acquisition, but also they should positively contribute to net dollar retention when they reach their 13th month and become part of our NDR cohort. Our Q2 net dollar retention was 99%, up from 97% in the same quarter last year, and within the expected range that we communicated on the prior quarter's call. We also delivered strong AI/ML revenue growth in Q2 as we continue to see a robust demand environment, particularly for inference workloads, with AI revenue growing north of 100% year over year. Turning to the P&L, we delivered strong performance on all of our key profitability metrics. Gross margin for the second quarter was 60%, which was 100 basis points higher than the prior year. Adjusted EBITDA was $89 million, an increase of 10% year over year. Adjusted EBITDA margin was 41% in the second quarter, approximately 100 basis points lower than the prior year. Non-GAAP diluted net income per share was 59 cents, a 23% increase year over year. This increase is a direct result of expanding per share profitability by driving durable revenue growth while exercising ongoing cost discipline. GAAP diluted net income per share was 39 cents, a 95% increase year over year as we continue to grow revenue, drive operating leverage, and prudently manage stock-based compensation. Q2 adjusted free cash flow was $57 million, or 26% of revenue, up significantly from our front-loaded Q1, which included a large portion of the upfront investment required to bring the Atlanta data center online. As I'll detail later in my comments, we remain confident in our ability to deliver attractive adjusted free cash flow margins for the full year, although the timing of capital investment payments will continue to create quarter-to-quarter variations in adjusted free cash flow margins, hence our highlighting of the trailing 12-month adjusted free cash flow margins on slide 15. Our balance sheet continues to be strong as we continue to maintain material cash and cash equivalents, and ended the quarter with $388 million in cash. We also continued to execute our share repurchase program in the quarter, with $20 million of repurchases in Q2, buying back approximately 691,000 shares. This brings our cumulative share repurchases since IPO to $1.6 billion and 34.8 million shares through June 30, 2025. At the end of Q2, we had 3.4 million remaining on our current share repurchase authorization. On the debt front, we continue to actively evaluate the market and our financing alternatives and remain committed to fully addressing the 2026 convert over the balance of this calendar year. We have multiple attractive financing options available to us, including convertible debt, bank debt, and bonds, and we plan to tap into these markets as needed to optimize our long-term cost of capital. Before we move on to guidance, I'll highlight one non-cash item related to both the balance sheet and the P&L. We continue to evaluate the necessity of our valuation allowance on certain existing deferred tax assets each quarter in accordance with U.S. GAAP. While the valuation allowance is still necessary for Q2, in the latter half of fiscal 2025, we may release all or a portion of our valuation allowance of $109 million, which was discussed in our most recent 10-K as well as in our most recent 10-Q. When released, we estimate this would have the financial impact of decreasing our non-cash tax expense by the amount of the release, resulting in a corresponding increase in net income. When this occurs, it will be a positive non-cash event and will have no impact on non-GAAP financial metrics. Moving on to guidance, for the third quarter of 2025, we expect revenue to be in the range of $226 to $227 million, representing approximately 14.1% year-over-year growth at the midpoint. For the full year 2025, we are raising our annual revenue guidance to the range of $888 to $892 million, representing approximately 14% year-over-year growth at the midpoint. Given our strong Q2 performance, visibility into our customers' usage trends, and the strength of the AI/ML demand environment, we are able to raise our full-year guide with confidence. For the third quarter of 2025, we expect our adjusted EBITDA margins to be in the range of 39 to 40%. For the full year, we raise our adjusted EBITDA margin guide to the range of 39 to 40%. For the third quarter of 2025, we expect non-GAAP diluted earnings per share to be 45 to 50 cents, based on approximately 102 to 103 million in weighted average fully diluted shares outstanding. For the full year 2025, we expect non-GAAP diluted earnings per share to be $2.05 to $2.10, based on approximately 103 to 104 million in weighted average fully diluted shares outstanding. Turning to adjusted free cash flow, we raise our guided adjusted free cash flow margins for the full year to 17 to 19%. Increasing our projected cash flow margins at the same time, we are accelerating our revenue growth outlook, which speaks to the confidence we have in our ability to maintain attractive free cash flow margins while we accelerate our top-line growth. Consistent with our historical guidance practice, we are not providing adjusted free cash flow guidance on a quarter-by-quarter basis, given it is heavily influenced by working capital timing, as you saw in our year-to-date results. That concludes our prepared remarks, and we'll now open the call to Q&A.
Thank you. We will now begin the question and answer session. If you would like to ask a question, please press star one on your telephone keypad to raise your hand and join the queue. And if you'd like to withdraw your question, simply press star one again. We also ask that you limit yourself to one question and one follow-up. Your first question comes from Patrick Walravens with Citizens. Please go ahead.
Oh, great. Thank you very much, and congratulations. Patty, could you talk a little bit more about the AI/ML revenue and the over 100% increase there, and maybe walk us through a little bit the history of this offering and why the current version is really starting to kick in?
Yeah. Thank you, Patrick. Good morning. Good way to get started. So the AI/ML revenue, as I mentioned in the call, grew more than 100% year over year. So if you remember, last Q2 is when we brought a lot of H100 NVIDIA gear online. So more than doubling that this quarter was a significant step for us. And what is different is, as I explained, we have a 3-layer AI stack. On the foundational level is our gradient AI infrastructure stack, which is a network of GPUs, both from AMD as well as NVIDIA. And then in the middle layer is our gradient AI platform that we just took from private and public preview all the way to general availability. And then on the topmost layer is agents. So the type of customers that use these 3 layers are slightly different at this point. So AI infrastructure is consumed typically by AI native companies that have their own model or have taken an open source model and are doing some tweaks to it and hosting those models and scaling them, especially in the inferencing mode, are typically consuming the AI infrastructure. And a majority of our revenue comes from the gradient AI infrastructure stack. And that's not very dissimilar from the rest of the industry. The gradient AI platform that we recently pushed out to GA is where any software application, like a SaaS provider, for example, can start consuming AI into their own applications without having to do the heavy lifting of building and managing their own GPU infrastructure. So we have serverless endpoints for these LLMs, for example, and we have a bunch of other tools and modules that are critical building blocks for consuming AI into your own application. So it becomes very, very easy to build AI into your existing application. And that's what is powering the growth of our AI revenue, is predominantly on the infrastructure side, but we are driving a lot of adoption and mindshare with developers with the AI platform. And on the agentic layer, the first commercial application of that is the Cloudways Copilot. That's typically adopted by end customers as a way to automate some of the manual tasks that they're seeing in managing and operating cloud-based applications.
That's very helpful. Thank you.
Your next question comes from the line of Mike Cikos with Needham & Company. Please go ahead.
Hey guys, thanks for taking the questions here. Just to further the conversation on the AI ML, good to see the north of 100% revenue growth, reflecting some of the more recent trends you guys have seen on the ARR front. We just wanted to see, I know historically you guys have given us more color on the underlying components for that net new ARR. I think last quarter you guys had cited north of 160% year on year. Maybe I missed the data point, but just wanted to see how that net new is growing on the AI ML front in the June quarter.
Mike, Matt, I think what we said is that our ARR was growing. The AI ARR was growing north of 160% in prior quarters. That wasn't referring to the incremental ARR, it was the actual ARR. And the north of 100 reflects still, very strong growth. In fact, if you look at the incremental ARR for this quarter at 32, it was a good balance across both AI and core cloud. But it was our highest incremental ARR in the company's history. And the reason that it dropped, if this is where you were going with the question around from 160 to north of 100, is just as Patty had said, we lapped the Q2 when we launched all of our our AI capabilities, and we had a bunch of pent up demand. So the Q2 growth in the AI business in particular from last year was high, so it was just a difficult comp. But if you look at the incremental ARR that we're adding for the in that business on a go-forward basis, we're accelerating. It's an accelerating business.
Got it. And for the NDR, I know that the 99% here is in keeping with that commentary you guys have provided last quarter. Can you just explain what actually acted against that? Because I would have thought there would have been at least some benefit from you guys lapping that Cloudways price increase in April.
Yeah, I think that when we look at the NDR, and this is the reason that we signaled it'll likely bounce around the kind of current range, into this quarter and probably going for the next couple of quarters, is that in the market, we haven't seen a degradation market. We haven't really seen any change in the market since the April timeframe. But as we look at some of our larger customers in the long tail, I'd say there's a mixed impact on customers. It's very individual. So some customers we see that are maybe on edge and they're optimizing, or they're a little bit hesitant to expand their business. But in the same industry or in the same size of customer, we also see a number of customers that are accelerating the business. They're doing really well, and they're expanding their business with us, and they're growing their workloads. And you see that in the growth of the customers, the Scalers Plus at 35%. So we're seeing really strong growth in parts of our customers, but we're also seeing others that are being cautious and aren't scaling as fast. And so we think that we're likely to stay kind of in this level. I'd say what the good news is, despite the fact that the NDR was just a hair lower at 99, we were able to raise our guidance. We're delivering the best incremental ARR that we've delivered in a very long time. And so we're very encouraged by the trends. I think that NDR is still, it's such a laggy metric. It's going to be a little stubborn to improve, but that's not going to slow us down from a revenue growth standpoint. We're doing enough with the new product acquisition on the core cloud, which is doing really, really well, getting really good cohorts that are coming in. We've got the migration motion, which is a relatively new motion. It doesn't always impact NDR. And then we've got the growth and acceleration in the AI business. So we're very bullish on the growth prospects, and that was what enabled us to raise the guidance for the year.
Great. Thank you, guys.
Your next question comes from the line of Gabriela Borges with Goldman Sachs. Please go ahead.
Hey, good morning. Thank you. I wanted to touch on the unit economics of the AI business. Matt, I know in the past you've talked about the 3-year payback period, but you'll have both been very consistent in saying as you move from bare metal GPUs to more differentiated services, exactly as you've illustrated in the graphic in the slides, you should be able to command more gross margin essentially. So maybe give us an update on how those efforts are tracking. How do you feel about the gross margin and the LTV to CAC of the AI business relative to the core business?
Yeah, we're very we are very encouraged and comfortable with the margins that we're getting in the AI business. As you said, Gabriela, the higher layers of the stack, the 3-layer stack that Patty describes, have better margins than pure infrastructure. But even at the pure infrastructure level, we're very comfortable with the returns, particularly given the long-term value that we believe. You talked about the LTV, the long-term value that we believe we'll generate from those customers is, as Patty has talked about multiple times, inferencing customers, which is what we're seeing more and more of, even at the infrastructure layer as we're kind of going through this. They will pull other cloud services through. They need databases, they need storage, they need bandwidth, they need standard compute CPU. And so, this is a bit of we're still investing ahead in terms of, okay, if there's a bunch of infrastructure, the margins on that are lower than the margins at the higher stacks, but you need that baseline infrastructure capability to get the higher layer services. And so we think it's a very good investment. It's a very good use of our capital, and we're very encouraged by the returns that we're getting and the promise of higher returns as that business matures and then we get more pull-through revenue and we get more of the revenue shifting to the higher layers of the AI stack.
And just to add to it, Gabriela, this is Patty. Just to add to what Matt just said, that's why we're also forward investing in making our Gradient AI Agentic Cloud very, very optimized for inferencing. So I talked about our inference optimized droplet. If you look at that right side of the slide 8, you will also see that we are investing in model optimization. We are investing in infrastructure optimization at the infrastructure level. Everything is aimed to scale inferencing workloads on our platform, which tend to have very long tails. And as Matt mentioned, they also drag through some of the other cloud primitives. So they drag the left side along with them as the inferencing workloads scale globally. So we feel very good about where we are and some of the early success we are seeing with very marquee customers that are starting to scale up their inferencing footprint on us.
Yeah, that makes sense. Thank you. And Patty and Matt, the follow-up I have here, just on these comments on highest incremental ARR, highest organic ARR in over 3 years in terms of the net new that you're adding. Can we think of this as the new high watermark? And looking at what's being implied in guidance, talk to us about your ability to consistently deliver growth off that metric and whether there's any unevenness, whether because of seasonality or company-specific factors like the timing of new AI capacity coming online that we should be aware of as we think about the forward model.
Yeah, I can start, Matt, and you can fill in. So we did not have anything unnatural this last quarter. Like we didn't bring a bunch of capacity online or there was no seasonality associated with it. I think we are just as we mentioned in our prepared remarks, we are honing our product-led growth motion for our core cloud customers, and that is starting to really produce results. On one hand, our migration motion is bringing in a new type of customers that are typically digital native enterprise customers.